It's Charlie giving you Wednesday's video. Hope you're very well. Today's video is titled "Why I Use One Reason to Use even Simple Moving Averages rather than Exponential." And so I'm just going to give you a single reason as to why I use simple moving averages. And I'm actually going to use the new pen tool that I've got and see if this works. Okay, so I've got to click on pen, haven't I? Yeah, see, I knew I'd get something wrong. Right, there we go. I think I've got a pen here. Yeah, here we go. So I'm going to draw this on using my new pen tool, and what I want to put in is some price action here. Oh yeah, okay. So it's something like this, and let's put some support in here. So let's say this is my 50-day moving average, DMA. I've got it set to a simple. It could be a 20. Quite often it's a 20 as well. I use this on, so a 20 or a 50. And if I see that price has come down below something like a 50 or a 20 period moving average, but that moving average is still facing upwards, price has come down and hit a support zone, then I'd be looking for reasons to get long. This is the reason why I don't use exponential, because an exponential moving average is more likely just to be moving much quicker along with price, so it doesn't give you that heads up, so to speak. So it's a nifty little trick that happens, enough, and I can use it whether I'm day trading or swing trading. That moving average, simple moving average facing upwards, price has broken through it, come below, but then hit some sort of support area. And then look for reasons to be getting long for a tradable bounce. So okay, so that's the theory behind it. Let me see if I can find a couple of examples. I've got one here. And these are genuine, actually. These were actual real, although this is a monthly chart, I'm going back here on dollar CAD. But it's not that I've had to go back to 2016 before anyone says. It's just just looking at the charts. But dollar CAD, back in both of these situations, I actually traded these. So back here, first of all, in real time, this is a monthly chart. Price had gone below that 20 at that time. We'd pulled back into these prior high zones here. Obviously, it's never an exact science. We're back into this prior high zone. We'd pull back into the 20, overshot it a little bit, with the 20 facing upwards at that point when price was, it'd gone a fair bit below, maybe 100 pips or so below that. So then what we did is I did this with our swing traders at the time, then we used other setups to get us long on like a daily chart or whatever. And the same sort of thing we can see happened here, intra-month, when price overshot the 50 period moving average here, and the 50 was still facing upwards even though price was right down here, again into a support zone. We used that on the smaller time frames to get long. And we can take it even down to I'll give you a much more recent example, which would actually be Aussie dollar from just last week, where the 20 period moving average, even though Aussie had a fierce sell-off down into support down here, but the 20 was still facing up, so we were looking for long opportunities to trade a bounce. And so again, it's an example of a bounce coming through when you've got a moving average facing upwards still. Once it's started to curve over, then that's it, game over. But that's why I use simple moving averages, or one reason why I use simple moving averages. It's a nifty trick. It's why I don't like it exponential. They move too aggressively. Again, it's a personal thing. I'm just telling you why I use simple, not exponential. There you go. That's Wednesday's video. See you on Friday.